I'm Susan Jabinski with Morningstar. We're in the thick of tax season, which means many investors are making IRA contributions, and target date funds can be ideal IRA investments. Here to discuss why that is and to share a few of Morningstar's favorite target date funds is Jason Kephart. Jason is Senior Principal with Morningstar's Manager Research Team. Hi, Jason. How are you?
Good.
All right. Well, let's get right into it. You know, Christine Benz, which both of you and I have known for years, she's Morningstar's Director of Financial Planning. She's been saying for years that target date funds are these great investments for an IRA because if investors choose the target date fund that fits their time horizon, then that IRA sort of effortlessly fits in with the rest of a portfolio. Delve into that a little bit more.
Yeah, target date funds are really just a great set it and forget it for investors who don't want to spend a lot of time thinking about, well, how much of my portfolio should be in stocks versus bonds? How much should be in US stocks versus international stocks? What fund should I pick to fill those buckets? You know, the target date really takes all that off the hands of investors. And then the other beauty of it is they're regularly rebalancing for you, so your portfolio doesn't get out of whack. And then as you age and get close to retirement, they're generally rebalancing so that your portfolio is getting a little bit more conservative because you don't want to have a lot of risk at retirement, but you do want to have a lot of risk when you're young and have a huge time horizon in front of you. So this takes care of all of that for you. So a target date, really a great option for anyone who doesn't want to spend a lot of time doing that and would rather do something better like, you know, watch football.
There you go. Now, Vanguard was in the headlines lately after making some pretty sizable distributions from some of its target date funds. So now, although Vanguard's distributions maybe were pretty big, target date funds in general aren't really great investments for taxable accounts. Talk a little bit about why.
Yeah, they're predominantly designed for 401k plans, which is most of where the assets are. And these are tax advantage accounts like an IRA. So they're not really thinking about taxes. So the bond portfolio tends to be taxable bonds, so that income's taxed at an ordinary rate. And also, like we talked about the rebalancing. What rebalancing does is you sell your winners and buy your losers. And anytime you're selling your winners, that's going to trigger a taxable event. So in a 401k or an IRA, that's really you don't really have to worry about it. In a taxable account, it could be kind of a headache.
So Jason, you know, a lot of investors already have a relationship with, you know, a brokerage or, you know, an asset manager in particular. So can they, you know, feel pretty comfortable or confident just going with whomever they already have that existing relationship with, or does it pay to shop around?
I think it always pays to look at your options, but I would caution that a lot of brokerages will kind of take steps to steer you towards their own kind of offerings, which may mean some additional fees may be charged if you pick a different target date fund, and that might kind of kill the value proposition because you don't want to pay any extra fees than you really have to. And what we've seen with target date funds is the return differences can be fairly narrow. So if you are adding on additional fees, that could make a significant difference.
All right. So then what are some of those key questions that investors should be asking before they invest in a target date fund?
I think you want to know what the glide path looks like and whether or not it fits your risk tolerance at different stages in life. And this could be very difficult to know early on. A 25-year-old probably isn't going to have a good sense of what their risk tolerance is going to look like at 60. But the shape of the glide path really does matter. You also want to understand what the underlying funds are. Are they index funds, actively managed funds, or are they kind of a combo of both? And you know, maybe you have a preference there. And I think the other thing you want to think about is the fees. I mean, fees really matter, particularly in an IRA where you may not have the benefit of kind of getting the cheapest share class like you would through a company 401k. So I think keeping that in mind is really important.
All right, it's time to name some names, Jason. You've brought us today 3 target date series that Morningstar likes. The first one is that Vanguard series, Vanguard Target Retirement. So is this all index funds?
Yep, it's all index funds. And I think it's really important to remember that even though there have been a lot of headlines over the capital gains exposure, Vanguard's target date is still a really good option for everyone. It's probably the benchmark by which all other target date funds are judged. That doesn't mean necessarily the best, but it is a really good option if you can get access to it. It's super cheap, 8 basis points no matter what which vintage you pick. And it is a really sharply made glide path, I think. The asset allocation is all index funds, so you don't have to worry about active managers underperforming, you basically are going to get kind of the market return that you would expect from the portfolio. So it does really fit what people would expect, which I think is also really important. So I think one thing that might make people sell a target date fund when they shouldn't is performance that doesn't really match what they see in the market. And so that's something you don't really have to worry about with the index-based ones.
Yeah, so then you touched on the glide path. Talk a little bit how aggressive this series is in terms of its glide path or its asset mix.
Yeah, so its glide path kind of falls in line with kind of the industry. I don't know if that's because everyone wants to be like Vanguard or kind of starts with Vanguard and makes changes from there, but starts around 90% equity at the beginning. And then at retirement, it's around a little over 50%, which I think that's where, you really have to think about the risk tolerance part. Is 50% equity, more or less than you're really comfortable with at retirement? So that's something I would think about when choosing the Vanguard one.
And then anything about its asset mix?
It's the broadest base, probably asset mix you can get. It's emblematic of Vanguard. You get Vanguard total stock market, Vanguard total international stock market, total U.S. bond market, and then total international bond market. So you really are covering, pretty much the globe. The asset classes that are kind of missing would be high yield bonds, which, I think in a diversified portfolio may not add as much benefit as they might look like they do on their own, just because they do have some equity-like risks. So if you're using that as a bond portfolio, it might be a little bit riskier than you think, but you're generally getting access to all the market cap weighted securities in the world.
All right, at a good price too.
Yeah.
All right, so then I'm assuming, is that the biggest selling point? Is that why you really like it? Is that broad diversification at a low cost?
Yeah, super broad diversification, low cost, no frills. It's going to deliver what you think it's going to deliver. So I think that makes it easy to own, and it's going to kind of deliver for people over the long run.
All right, Jason. So the second target date we're going to talk about today is actually an ETF, iShares LifePath Target Date ETF. Assuming this one also focuses on index funds. And I didn't even know that there was such a thing as a target date ETF. Tell us about this one.
It's the only target date ETF available. It was launched in 2023. And although it is new, it does follow the same glide path and asset allocation framework as BlackRock LifePath Index, the mutual fund version, that's been around for more than a decade. So even though it's a new fund, it's not really a new fund. It's more of a new wrapper. But what makes the wrapper interesting is that you get it at a very low cost. Expenses are going to range around 10 basis points for the whole series. And also you get a really interesting glide path. So Vanguard starts at 90%. iShares LifePath starts at 99%. So it starts a little bit more aggressive when you're younger, and arguably younger people can afford to take more risk early on. So I think I like that component of it. And then as you get closer to retirement, it actually goes to 40%. Which is pretty low, lower than the average target date fund. But again, what you want to do near retirement is kind of lower the range of outcomes. And the way you do that is kind of by having less equity exposure, because that's going to lead to less volatility. So you have a little bit more certainty heading into retirement with this series. So that's one aspect I do like. Within the portfolio, it's kind of it's index-based, all ETFs. It is broadly diversified too. They're a little bit more granular in their exposure instead of using very big, broad index funds. They have more granularity, which I think lets the managers have a little bit more viewpoints in the portfolio. And we do think the BlackRock multi-asset team is really good. So letting them have those viewpoints we see as a benefit.
Got it. So, but it's still from an asset mix standpoint, they're still kind of covering the waterfront.
Yeah.
Similar to Vanguard in terms of what you're going to get exposure to if you're invested in it, right?
You're getting broad global stock exposure at the end of the day, a lot of different fixed income exposures. So there is a lot of diversification there. They're really smart about it. Again, high yield bonds aren't a part of the mix here. So you do get really kind of bond portfolios that kind of act more like bonds. Which is sometimes a good thing, most of the time a good thing. 2022 kind of an exception there, but I think going forward, bonds are in a much better place than they were. So having that high quality bond exposure should help kind of also reduce volatility.
And now this one actually gets a gold medalist rating from Morningstar, and we just don't hand those out to every security. So what's sort of the driving factor behind that very high rating for this one in particular?
Yeah, so it's a combination of low fees. I mean, obviously that matters. Also, we just have a very high confidence in the team's ability to execute its process. And the things I pointed to in the glide path, I think also kind of are a bonus for it in terms of the process. And the team has just really shown a kind of a more forward-thinking approach to asset management than I'd say the average target date fund.
All right, Jason, so the last target date we're going to talk about today is from T. Rowe Price. It's T. Rowe Price Retirement. Is this active or passive?
We'd say active-based. They're predominantly active management. It's all T. Rowe funds. They do have an index fund in there, though, which kind of helps control costs a little bit. But it's generally where you're buying it for is the T. Rowe Price active management component, which really is going to help drive returns.
So Jason, tell us a little bit about how the T. Rowe target date series, how its glide path and asset mix sort of compares to what you told us about the iShares and Vanguard options.
Yeah, so T. Rowe is probably the best fit for someone who has a bit more risk tolerance than someone in the Vanguard or iShares series. It starts out at around 98% equity, but then instead of getting closer to 40% like the iShares one does at retirement, its equity exposure stays a bit elevated, over 50%. And its bond portfolio tends to take on more risk than you would see in an index-based target date series. So you have more growth opportunity for sure, but you also do have to be aware of that kind of risk, particularly around retirement. I think that's when people are probably the most risk adverse. So that's something you really, I think, have to be content with when you are using the T. Rowe series.
So Jason, wrap up by telling us why T. Rowe Price Retirement is one of your picks today.
Yeah, similar to the other target dates we talked about, the multi-asset team, we really have a high degree of confidence in. They've shown a lot of sharpness over time. They made changes that really make sense. And then also, I think the underlying funds, you really have to give a lot of credit to them too. If we didn't have a high degree of confidence in T. Rowe's equity and fixed income managers to deliver, then this series wouldn't be as appealing. But because they are such a notable active equity manager and active fixed income manager, I think that helps really raise the bar for it.
Well, Jason, thank you for your time today, and I guess I need to go open my IRA and get it invested in a target date.
Good luck with that.
Thanks. I'm Susan Javinsky with Morningstar. Thanks for tuning in.